The month of October marks the beginning of the festive season in India. We've got Navratri, Diwali, Chhath Puja, and Christmas all lined up. This time also signifies the start of the great Indian wedding season. As we consider this season auspicious for big purchases and fresh beginnings, our favorite brands also line up with deals and discounts. Buying a new car or moving to a new house, purchasing gold for wedding, or investing in shares during Muhurat trading, these festivals offer an ideal opportunity to acquire new assets, not only for personal use but also for friends and family, isn't it? The exchange of gift is deeply ingrained in our culture and it serves as a way of expressing affection. However, there is another aspect to consider, is that gifts also come with tax implications. Yes, you heard that right. While the value of most presents is usually small, there are cases where gifts such as property, jewelry, shares, etc. can hold substantial value. In such cases, you might be required to pay taxes on the gifts you receive. Hello, I am Vishvajit Sonagara, founder of Quico, India's leading tax filing platform. In today's video, I'll help you understand how gifts are taxed in India. We will cover what is considered a gift according to Income Tax Act, tax implications on gift in India, how to calculate the taxable value of a gift, and last but not the least, how to declare taxes on gifts in India. But before we jump in, hit that subscribe button and notification bell so you never miss out on any of our upcoming videos. Alright, ready to roll? Let's get started. According to the Income Tax Act, gifts are broadly categorized into three types: monetary gift, gift of movable property, and gift of immovable property. Let's break these down. First, a sum of money received through cash, draft, check, or bank transfer is considered a monetary gift. Second, if you receive assets such as jewelry, shares, bonds, paintings, or even VDA such as cryptocurrencies, they fall under the category of movable property. And the third, receiving real estate assets such as land, buildings such as residential or commercial properties is termed as a gift of immovable property. Clear so far? Excellent. But how is gift different from purchasing an asset yourself? Well, if you receive any of these assets from another individual or organizations without making any payment or by paying less than the fair market value, it will be considered as a gift. Quite simple, isn't it? Great. Now let me explain to you the tax implications of gifts in India. As per the current tax laws, if the value of gift received by an individual is worth more than 50,000 in a particular financial year, then the entire value of the gifts will be taxable. Let me explain this with an example. Suppose Rahul receives 20,000 from his friend Mansi on his birthday. The amount will not be taxed because it is below 50,000. However, 2 months later, Mohit, another friend of Rahul, gives him 40,000 on his anniversary. The total value of gift received by Rahul during the financial year is now 60,000, surpassing the 50,000 exemption limit. Consequently, Rahul will have to pay tax on the entire 60,000 he has received as a gift. Now, not all gifts in India are subject to tax. I'll list 5 cases in which tax on gifts received is exempt in India. The first case is when the cumulative value of gift received is below 50,000 in a financial year, which we have already discussed. Next is gifts from relatives. Gift received from relatives on any occasion of any value are non-taxable. The Income Tax Act clearly defines who qualifies as relatives. They include spouse of the individual, brother or sister of the individual, brother or sister-in-law, uncles and aunts on both your parents' sides, parents or grandparents, and children or grandchildren or their spouses, and your in-laws. Pretty exhaustive, right? Let's move ahead. Third case is gifts received on marriage. Marriage is a special event and it's common to give expensive presents such as jewelry and property on the occasion of marriage. Hence, any gift received of any value from anyone on the occasion of marriage is not taxable. Fourth is gifts under a will or by way of inheritance. If you inherit money, movable or immovable property, or any asset for that matter, it will be exempt from taxes. And lastly, gifts received from designated institutions. Gifts from a defined local authority, fund or foundation, university or any other educational institution, hospital or other medical institutions, any registered trust or institution, and a recognized religious or charitable organizations are exempt from taxes. Now it's important to note that any income earned from investing the received gifts or assets is taxable. For example, receiving interest income from money transferred into your bank account, rental income from gifted property, or capital gains from sale of gifted shares are all subject to taxes. Okay? Let's move on to the next section where we will understand how to calculate taxable value of a gift under different cases. The Income Tax Act includes provisions for calculating the taxable value of gifts. There are various cases to consider, and to simplify this, we have created a table for your reference. Looking at the first row, it's quite straightforward and we've already covered this. If you receive a monetary gift worth more than 50,000, the entire amount will be taxable. Now let's consider immovable properties. There are two possible cases. In the first case, you've received an immovable property such as land without making any payment. In this scenario, if the stamp duty value of the property exceeds 50,000, the taxable value will be equal to the stamp duty value of the property. The second case involves a situation where you have paid for the property, but your purchase price is lower than the fair market value. This is known as inadequate consideration. In such cases, if the stamp duty value of the gifted immovable property exceeds the purchase price by more than 50,000, the difference between the stamp duty value and the purchase price of the gifted property becomes taxable. For example, if the stamp duty value of the gifted property is 5 lakh and the purchase price is 4 lakh, the taxable value is 1 lakh rupees. Moving on to movable properties. Similar to immovable properties, there are two cases. First, if you haven't paid anything for the gift and the fair market value of the gift exceeds 50,000, the entire fair market value of the gift becomes taxable. Second, if you have received the gift with inadequate consideration, then the difference between the fair market value and the purchase price of the gift is taxable, provided that the difference exceeds 50,000 rupees. For instance, if the fair market value of jewelry given as a gift is 3 lakh and the original purchase price is 2 lakh, the taxable amount is 1 lakh. That covers the basics. I hope you've been following along. If you have any doubts or questions, please feel free to ask in the comments and we would be happy to answer them. Alright, now before we proceed further, let me ask you a question. What do you typically do once you receive a gift? Do you enjoy it or do you declare it? What's your take? Of course, we all enjoy our gifts, but it's equally important to declare these gifts while filing your income tax return. So let's dive into this process. How to declare tax on gifts in India? As per the current income tax rules, the donee, that is the receiver of the present, is responsible for declaring and making the appropriate tax payments. To calculate the tax payable, the donee needs to declare the value of the gift at the time of filing his income tax return under income from other sources head. The tax liability of the gift is then calculated according to the income tax slab rate of the donee. Let's consider an example. Rahul's annual income from salary is 8 lakhs. He has earned capital gains worth 2 lakhs. He has also received shares as gift from his friends worth 75,000. Now his total income is 10 lakhs 75,000 rupees, which places him in 30% tax bracket under the old regime. Understood? Great. Now before we conclude, it's important to remember that tax planning using gift is quite common in India. As a result, gifts often come under the scrutiny of the tax department, especially if the value is substantial. Hence, it is advisable to maintain necessary documents to establish the genuineness of the gift received and sufficient sources of the fund with the donor to justify the gift. So that's it, folks, for this video. If you found this video helpful, make sure to hit that like button and subscribe for more tax related content. Until next time, this is Vishvajit signing off.